10-year note yields closed this week at their highest point since July 26th. So before the first Fed cut, before a lot of the turmoil we saw in the stock market, and before the market got very comfortable in a 160, 180, 165, 185 range. And as we've broken out of the range, the momentum started to pick up on Wednesday and Thursday, and it slowed a bit on Friday as there was some headlines from the president talking about not getting quite there on the China deal yet. Sort of stops stocks from seeing their ascension. Treasury stopped selling off. Gold stopped selling off, and everything just sort of stuck in its tires. We're roughly unchanged across the board from yesterday's settlement. However, it was really just a headline watching week, and we'll probably continue to do the same thing next week. As far as the China-U.S. trade deal goes, we'll talk about that in a sec, but that has really driven the markets here. At this point now, 2% becomes very important. We came within a stone's throw of it today and yesterday, but I think at this point that's going to be a very, very tough support line to get through to the downside in price and resistance to the upside in yield. 2% hasn't traded in a long time, and some maybe didn't even think we'd get there this year, as the market had really been pushing yields lower, prices higher, with all the crazy back and forth that we've seen, not only with U.S. and China trade, but what's happening in Europe with growth and global growth, with U.S. Policy, Fed policy here. It's all been all over the map, but now seems to have gotten a bit of direction. Momentum to the upside in yields is here, at least for the short term. And if you look at market volatility, we saw a very welcomed bid. It came late Wednesday, all day Thursday, and things just sort of plateaued on Friday. But obviously we broke out of the old range. The market's now gearing towards levels not seen since the summer. And some of the move was so fast, it caught many off guard. I don't think anyone thought we were going to stay at those low yields forever, but I certainly didn't think we'd see a 33 basis point rally in 10-year note yields from last Friday's low. So in 1 week span, we saw a very, very big move. Market was not really prepared for that speed of a move, hence volatility caught a nice bid, the highest it's settled in quite a long time. And lastly, what about this China-U.S. trade deal? It's kind of the headline that won't go away. We've been following it now for months, if not years, since these trade talks began. And it's the same two headlines that move the market. U.S.-China trade deal looks positive, U.S.-China trade deal doesn't look positive. And we get one or the other, and the market typically knee-jerk overreacts to whatever happens to be going on. And today we didn't see as much of an overreaction as we saw a stopping of the reaction. So yesterday we got the positive news that potentially we'd have a deal at the NATO meeting come first week of December. And now Mr. President came out and said, not so fast, nothing's been done yet. And that's probably the prudent thing to say, because at this point, nothing has been done yet. And at this point, we will have to wait until we get some of those tariff rollbacks on paper and get something signed. So at this point, we will continue to watch that. Yes, we will also continue to watch the economic data. It certainly doesn't weigh as much as it used to. And lastly, the Fed policy that we had been expecting, another Fed cut this year, is gone, at least in market expectations. And if you look at the Fed fund futures, there is almost nil chance that they will be cutting again this year. Yes, there is still a small chance they'll cut in 2020. That's a long way off, and we have a lot of data and a lot of agreements that need to be signed between then and now. So it looks like into year end, things could keep moving the way they are. I don't think 10-year note yields will get much further above 2%, even if they do get there, as we will have to start dealing with some of the global growth issues. Now, while we're looking at data being a little more positive here this week, it needs to see a sustained period when we get higher levels of economic data. Likewise, if we continue to see those auctions come in, that will be a reverse push. That'll help push yields higher. But at this point, we've been dealing with some very large auctions for quite some time, so I don't think that's any catalyst to this move. So as we head into the weekend, Treasury note yields at their highest since July likely will continue the trend next week, but at a much, much slower pace.